Okay. Testing. 1, 2, 3. Uno, dos, tres, cuatro, cinco. Un, deux, trois, quatre, cinq, six, sept, huit, neuf, dix. So how are you? Jumbo! Good morning. Today is, it must be September 16th, 2015. This is your daily Forex trading strategy session. Let's get this party started. Oh, yeah. Yeah, awesome stuff, huh? Yeah, welcome to Forex.Today. We're doing our daily Forex trading strategy session. Yesterday's right there. Look at it. It's right on the homepage. You can go whenever you want. If you want to attend tomorrow's webinar, you just click on webinar. Cool. So there's what? It's the 16th, and there's what? Over a dozen trading ideas already for today at Forex.Today. Neato. So how you doing, huh? My name is Wayne McDonald. I'm the Chief FX Market Strategist for TradersWay.com, an ECN that allows you to trade Forex, energies, metals, indices, and then scalp or hedge, which we talked about yesterday, using binary options. Neato. Hey, we do these sessions because we want you to be successful as a currency trader, and we want to be your trading partner for many years to come as your prime broker. We do these sessions every day, a couple of hours before the markets open in New York City. Now, trading and investing is risky, not appropriate for everyone. Your past performance, good or bad, is not indicative of future results. So I always stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, what do you think of this roll? This one's a quickie. Boom. Cool. Hey, I got a lot to talk about. It's the day before the Fed meeting, and there's a lot going on in the world. And let's get into the Illuminati stuff. I thought, first of all, we'd just go through the world and see what's happened in the last 24 hours. And then I thought we should talk about the Fed Funds Futures Fed Watch tool, published by the Chicago Mercantile Exchange. What do you think about that? Thought we could go over the VIX, take a look at how the markets are, how fearful the markets are of the upcoming changes, so on and so forth. How does that sound? Cool. Right on. Well, then I'm on the right track here. So again, thank you for logging in. I really appreciate your loyalty. You make being a currency trader fun, but you also keep me focused. Otherwise, I might not do this stuff. You know what I mean? So cool. You make me want to be a better trader. So I appreciate that. Okay, let's start with Japan. This is an hourly chart. Japan kind of moving sideways, but better than straight down. Right? Kind of sideways, but better than straight down. So we're stabilizing. Very nice. And a little more up, right, for today. Oh, where's my mouse? Too many screens, Wayne. Where? When I installed these cards, it's interesting. Like my mouse, I can move it, 1, 2, 3, 4, 5 screens to the left, and then I can keep going left, and it comes out on the right-hand side, and it's really weird because I'll move it left and I'll find it on the right-hand side, and so sometimes I lose my mouse. So I apologize for that. It's kind of a weird setting. Yeah, totally. It just loops and all right, so. Yeah, that's right. Vikrant's right. Japan got downgraded. Yep. That's why they got to do some QE or something, huh? Okay, so here's the hourly chart in euro. Not up, not down, huh? The euro stocks. Now going back, we've had some tough times. I wonder if I can get rid of that. Yeah, good. Had some tough times recently, right? Stabilizing. But of course, the way that you would set up a trade if you were going to trade this is you take the old support and it should be resistance in the future. And that trade has played out 3 times already. And it's still not heading down. So I think that's a clue. And what's interesting about the stock market is market participants behave differently with, dare I say, physical commodity. You're holding the stock. What's interesting is if you're going to buy the stock market anyways, you might as well buy it low, right? I mean, investors should be buying low. And you do get to a point when people buy it just because it's cheap. So the farther it falls, the more likely someone's going to buy it. Maybe we're starting to hit some of that zone, these big fast drops are opportunities for those that were not in to get in. At least that's how I look at it. Another way of looking at it is, like a trade wind. You're trying to cross the ocean, right? Is it easier to go from Africa to Brazil or Brazil to Africa if you were in a sailing ship? Yeah, I thought it was Africa to Brazil, but I grew up in the middle of Canada. I don't know a thing about sailing. I thought it would be easier to go from Africa to Brazil. So whatever. I guess maybe I screwed that one up. You know what is interesting though? If you get on a ship now in Brazil and work your way to Africa, by the time you get there, the front of your ship is covered in sand. Are the winds really from Brazil to Africa? But the currents are the what? Wait. Huh? Is that true? Okay, forget it. Maybe I shouldn't have said Brazil. Maybe I should have said Mexico. I guess, yeah. It's all about the wind. Yeah. All right. Don't listen to Don't listen to sailing analogies from someone that grew up in Saskatchewan. What was that, Rady? How the Germans doing? Yeah. Lots of sideways action. Maybe we'll put these on daily charts. Let's back this out a little bit. That could be yummy. Right? Little yum yum sauce there. Look at that. Beautiful. 786 retracement. And we're just caught on the 618. How'd you like to own Germany? Still a little late though, isn't it? Okay. Look at our bottom, guys. That was a 382. Okay. Don't you think that's interesting? Right there was a 382 Fibonacci retracement. I think that could be very interesting. Okay, in the UK. So the news came out in the UK that their jobs report was good, huh? Now remember, we're preparing for unexpectedly good news out of the UK by over the next 6 months, right? Right? The world's going to be shocked. So all of this is leading up. Um, the Bank of England can't raise interest rates unless they have some inflation and unless they have a stable job market, right? John, where have you been, John? I did a whole video to answer when and why, like 3 weeks ago, buddy. But not before the Fed. John Stir, John Arama. All right, look, Forex.Today. Bunch of the videos here on the right. 80-20 rule, hunting stops, price action, direction of trend, China, rebalancing, right, Bollinger Bands, history of the euro and the bond market. Wow, we've had some interesting conversations. Wait, that's not going to be videos. Just trying to find the video. I could tell you, but I already know, so you should know, right? What category do these things go over? Hang on. Stay calm. How does this get on? Category, category. All right, here we go. It should be in here somewhere. Something about the Bank of England, right? Bank of England, why? Look at all these videos we've done together. Isn't this cool? Look at all these videos we've done, you and I. Technical analysis, swing trading, fundamental events, RRR versus PPP. How interesting. I can't find this Bank of England one. Never searched on the site. Site searched. Where's my mouse? BOE. Let's try that. Forex trading session. How to know when the BOE will raise interest rates and why. There we go. This is for Johnny Boy. You guys have already done it. Oh, you're YouTubing it? Zoop, zoop, zoop. Okay. There we go. All right, so anyways, long story short, it's good that they're getting... So if we had a theory that they're going to raise interest rates in early next year, then part of the theory, part of the things that would be needed to happen to have that theory be correct would be improving job market. And so instead of losing jobs, they added jobs. And then last month's losses were pared back a little bit. So last month was basically a revision up. So, it's all working. Okay, it's all working. But remember, the big surprise is going to happen in about January, that everyone's going to be shocked. And we've already talked about it a month ago. So, coolio. Oh. So, Shanghai was up 4.5% today. Did you guys see that? It was down most of the day, and then in the last hour, up, 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 up. Dude, a 5% day? That's a good day. So we'll go over these other ones later, but so that's sort of the world as we know it. How's oil prices doing, by the way? Captain Obvious. Captain Daniel Obvious Chan, huh? Yeah, what? The Chinese stock market's manipulated? Really? No way! Yep. Yeah, up's better than down, right? So let's go, since we're just looking at various markets, let's look in here. And we want the sucker to go up. We have this little triangle set for it to go up. It's right in our zone. Still hasn't gone down. And that's what the oscillator does. In this case, a stochastic oscillator is looking at price's ability to make lower lows. So when it was going up, it was looking at this candle relative to the one before it, and it was higher and, more importantly, not lower. This one was not lower than the previous one. So 2, 3, 4 candles in a row without a low is part of the equation, okay? And which makes it oversold or has it turn up. And then this candle here actually makes a higher high relative to the previous ones. So you get it moving up, which is fine. Okay, no, not a low, but certainly a high. Not a low, but certainly a high. Not a high and almost a low. Well, that pulls the oscillator way up really fast from here to suddenly here, right? You see the big change from trending straight up to all of a sudden, whoa! Okay, no high, right? Didn't make a higher high than this high, and it made a lower than the previous 2 candles. Whoa! Okay, still not a high. Still not a high. Then coming down. Slightly low, slightly high, slightly low. No high. Right? Look at this. Basically no high, no high, no high, no high, no high. And all of a sudden no low, no low, no low, no low, no low. And what that does is starts pulling this oscillator around. Okay? And it's not making lows and it's not making highs, but it hasn't made the lows, which is the first part of the calculation. And now if it makes a high higher than here, then this certainly will start moving its strip up. So long story short, it ain't falling, and it's right on our line drawn last year. What? That's our line from December. Yeah. Cool. All right. So how does the world feel about the Fed decision yesterday? Oh, by the way, if you're a client of tradersway.com, you have $1 or more in your live account. There's a button to send you to the registration page for the event tomorrow. So you can register, and the agenda is we'll get together half an hour before the announcement. I'll tell you what goes on at a FOMC meeting. I'll teach you everything you need to know about what the Fed is, what the FOMC is, what they do, what they discuss at the meeting. I'll cover all of that. Then the announcement's going to come out at 2. Right, so the event will start at 1:30. The announcement will come out at 2. We'll get that faster than anybody else. And we'll trade the craziness. Whoa! And then at 2:30, Grandma Yellen is speaking. And so we'll do the live press conference. And I'll translate it into English. Okay. Okay, maybe that button's not up. It'll be there. So hold your horses. It'll be done by tomorrow. So anyways, so I'll cover the Q&A and stuff like that, and then we'll have a big group hug, and then we'll take off for the day. How does that sound? And of course, you're welcome to come, even if you're not filthy, stinking rich. You could open a live account and put like $10 in, right? I mean, it'll help. It'll certainly tell Traders Way that even though you don't have a lot of money, you really appreciate these webinars and working together with our team here. Because our team, it's not all about me. This team that we have is fantastic. What a great group getting together every single day. So, pop what you can in there just to show that you care and that it's important to you to keep it going. And then we'll continue to earn your respect, and you'll get better and more confident as a trader. And one day you'll put more in. We're patient. So anyways, let's talk about the way the world feels about tomorrow's event. What are the two most common feelings, emotions of a market? Eric, it's 2 p.m. or the event will start at 1:30 p.m. ET. I mean, look, you know when they're going to do the FOMC meeting, right? They do it at the same time. Yeah. So half an hour before that. But you got it. Okay, what are fear and greed? All right, well, do we have a greed index we can look at? Jefferson Johnson says VIX. Well, that's not greed, is it? But VIX is fear. That's what I want to look at. So the VIX now what is the VIX? What methodology do they use to create this fear index? This is an index of fear. What is it? Like, obviously, they're not going down it to the floor because there is no floor anymore, but to ask people, are you fearful? How are you more fearful today than yesterday? Well, what this has to do with the market buying options on the S&P 500. Why would you buy an option? Well, that begs the question, why would you buy any option? And options were designed to be an insurance. Felipe is absolutely correct. Insurance. Do you buy flood insurance when you live on top of a mountain? Okay, because you have no fear. The likelihood of you being flooded is pretty low. Well, yeah, you have to for raining. Okay, come on. But you know what I'm talking about, right? If there's little fear, then the propensity to buy such an insurance policy is very, very low. So why would you suddenly want to buy an option to hedge your exposure to the S&P 500? What are you actually worried about? What's your worry? Like, why would you waste money on an option? Risk. Well, what does risk mean? What's in simple words? Just why? What are you worried about happening? What sort of scenario are you worried about? It's not volatility per se. I mean, volatility could be the market going in your favor quickly. You're not worried about that. Losing money. Okay, you're getting closer to where I'm going to. Going against you. Okay, great. What direction are you probably? Let's get right down to it. How would you lose money? And why? And how would this option protect you? It's a hedge. I understand. But what is happening for you to lose money? What scenario would make you lose money and therefore would say, wow, I'm scared of that scenario happening, so I'm going to go and spend money now on an option. Remember, you're going to spend the money. Change your perspectives. You're making it too complicated. Maybe I'm not asking the question properly. I know it's an insurance policy. It is a hedge. You're being wrong, but what are you doing, and what would happen for you to be wrong? All right, I'm making it too complicated. So let me just say it then. But it's nice to really think. You have bought the S&P 500. You want S&P 500 to go up. Okay? That's what I'm asking. So if you're long the S&P 500, what are you worried about happening? Pete says, being wrong, and someone else said about losing money. That was Alexander, was losing money. So how would you be wrong? How would you lose money? All right, the stock market's going to fall. Thank you. I know it's a simple answer, and we're all very, very smart and lots of good answers. But this, in the simplest terms, you're simply worried about the stock market falling. Okay? Nothing else. So typically down here, this goes back 3 years of VIX. And just imagine price going up and down, or this index is going up and down, up and down, and up and down, and it's normal. And when it goes up, traders are buying insurance policies on their S&P 500 futures contracts. I suppose it doesn't even have to be that. Just an option on the S&P 500 falling. So if they're buying, which means this is going up, if they're buying, they're worried about the stock market falling. If the stock market falls and they have an option that pays the money in a declining S&P 500, then it's a hedge, and they'll lose money in the cash position, but they'll make money on the option, and that should offset at least some of their losses, which means even though they're buying the insurance policy, it's reducing their risk. Just like you buy insurance for your house, but it never floods, you never get struck by lightning, it never burns down, but it could. And it lowers your risk. Okay? So that's what it is. And there's some normal ups and downs in the marketplace, right? Just normal trading. But if I zoom in, if we go from 3 years to over the last 6 months, let's say, so you can see a little better. It looks a little strange, doesn't it? What happened recently? It went from 15 to 20, which is normal, to holy snap. From 15 to 55. Holy snap. That's bad. That's a lot of fear. Just imagine people freaking out. But they're not cashing out of their S&P 500 trades, are they? If you went to cash, you wouldn't need to hedge. No. Chem? Sem? Is it chem or sem? Is it does it sound like an S or does it sound like a K? Chem. All right, Chem. Yeah. The option that you would buy, because how would you structure this derivative trade? You would buy an option that makes you money if the S&P 500 falls. Okay, you can buy all kinds of options, right? So that's what it is. So you're buying, and some people have trouble with this concept, but you can buy an option that'll make money if the stock market goes up. That's an option. Just you can buy it. It's like it's an asset, right? You can buy this thing that says if the stock market goes up by higher than this price by this time, then I'll make money if it goes up. But you can also buy an option that'll pay you if the market goes down. It's not selling. You're not selling an option. You can buy, there's various options you can buy. One option is if the stock market goes up, you'll make money. There's another one you can buy that says if the stock market goes down, you'll make money. So in this case, you're holding cash positions. Let's say you have billions of dollars in the S&P 500, or even just lots of a whole stock portfolio, right? Doesn't matter. You're just worried about the whole systemic risk of the entire market coming down. And you don't want to get out of your long-term positions. So to hedge that, you buy an option that says if the stock market falls from today's price, the price right now, if it's lower in the future, you'll get paid. So that profit you made on purchasing that particular option, suddenly, or doesn't suddenly, will offset. So, maybe you only make 500,000 on your option, but you have several million in stock. So it just helps reduce the risk. I doubt it's enough to reduce it all, because you'd be throwing a lot of money. But anyways, so this goes up, and this is people freaking out. That's why it's called the fear index. Okay. What would we do as currency traders in a scenario like this? You buy a safe haven currency. So John's right. He said USD or yen. Well, depends on the scenario. The correlations of these things do change over time. Right now, the stock market, when it goes up, people are buying into the U.S. stock market, and they generally buy U.S. dollars. So I probably wouldn't say U.S. dollar right now. But the Japanese yen would likely get strong. Yeah. But potentially Swissy, like historically, and also as currency traders, everything is relative. So, in 2007 and 2008, when the entire world was collapsing financially, the US dollar got unbelievably strong because investors around the world were seeking protection, and they were buying US bonds. They were buying US treasuries. Therefore, they needed to get rid of their local currency because let's say they just didn't trust their own banks. Right? Or whatever, right? So they moved and they bought the safest investment in the world, US treasuries. And to do that, they needed US dollars. Well, now what they're doing is they're not buying bonds, they're buying the US stock market. So, so now maybe the fear part would lower the value of the dollar, because they're like, wow, is the S&P 500 going to crash? Wow, get me out of there. Right? And now the safe haven is going to be Japanese bonds. Right? Because of the assumption of the Fed raising interest rates. We covered that recently, but why would the Fed, why would you not buy U.S. bonds as a safe haven now? Well, everyone has a low yield, right, Anthony? Right, but why? Again, I'm asking why. I know what. See, most people know what because they read the newspaper and they listen to people on TV, and then I say, well, why is that true? And they're like, I don't know. I just read it in the Wall Street Journal. Like, it loses value, right? So in a scenario where the Fed is lowering interest rates and expected to continue to lower interest rates in the future, if you buy your bond today at 2%, let's say, let's go back to, let's just make up some sort of scenario. So I'm not talking about right this second, I'm just making it up. If you bought a bond at 2%, and in 1 year, the same bond is going to pay 1%, both bonds are issued by the U.S. government. They have the same risk. Okay? Which one's worth more? Do you want, if I sold you my bond, which we have secondary markets, that's the bond market. If I sold you, if you were looking for, bonds, one of them pays 2% and the other one pays 1%, which one do you want to buy? It's the same bond. You're like, well, all right, well, what if the other guy says, well, I'm really eager. I want to sell my 1% bond. What's he going to have to do to attract you? It's going to have to sell it to you cheaper. Lower his price. You see what I mean? So both bonds might say worth $1,000, right? They both expire somewhere in the future, but one pays 2%, the other one pays 1%. So the one that pays 1%, well, he'll have to lower his price. So that's how the bond market works. So as the bond market was falling, people were going to cash as soon as possible because they were losing money in the stock market anyway. So they got to get out of the stock market and they got to get into the bond market, right? And not lose money there because everyone's racing. So we're in the reverse now. The Fed is likely to raise interest rates. So if you bought now a 10-year T-note at 2.2%, and tomorrow they raise interest rates and the 10-year T-note goes up to 2.8%, you just lost money in the bond market. So you don't want to buy U.S. Treasuries in that sense. You might as well buy Japanese Treasuries, right? JGBs, Japanese government bonds. Is Japan going to raise interest rates next week? Is Japan going to raise interest rates next month? No. Is Japan going to raise interest rates next quarter? No. Is Japan going to raise interest rates next year? No. You get it? Well, Ishmael, I wouldn't worry about it too much. Long story short, I wouldn't worry about if or when or what if they don't do it tomorrow and whatever. Honestly, don't worry about it. But I just want to show you here that because then you say, well, Wayne, what do you mean don't worry about it? I hate when people tell me. Have you ever got basically screwed over by somebody that said don't worry about it? And then you later in time you're like, man, I just knew it, man. I knew I should have worried about it. I mean, it's like basically every time, right? Yeah, so it's like you should like change your behavior, right? The next time someone tells you to not worry about it, you just slap them. Open up your hand, wide open fist, and you just smack right across the face. Don't worry about that, huh? And you're like, my life just changed in such a positive way. Wait, I don't condone violence. All right, let's say it this way. Next time somebody says don't worry about it, you give them a big hug. You say, come here, give Papa Bear a hug. And he'll never say that to you again. All right. Let's instead of not worrying about it, let's just look at the facts. We're a day before, or I guess this is yesterday, as of yesterday, because the market hasn't opened yet, right? This is all pre-market, this webinar. Does this seem to you like the market's freaking out? VIX is, what's the actual number? 24. Right? Was as low as 22. Okay. We're not even that far from the 50-day simple moving average, right? So that's one way of looking at it. Isn't that nice? Felipe said, right? Felipe, you look at the 50-day moving average, which is what, 18, and we're at 22. It was 55. But we're back to, about normal. But if we were extremely worried about the stock market crashing tomorrow, wouldn't you start buying some options? Wouldn't you, if you were fearful as a portfolio manager, and you thought, you know what, tomorrow could be the end of the world, stock market to drop 10%, and I'll lose all my clients, right? But no, I don't see that. Do you? Do you see outrageous fear? Do you see outrageous fear? The world is preparing for the worst. It's the end of the world as we know it. I feel fine. Yeah, so interesting, right? Ishmael says, well, maybe they've already discounted the Fed. Yeah, could be, right? We don't know that, but we do know the facts that they're not freaking out, according to buying options on S&P 500 futures in anticipation of a great crash tomorrow. Is that helpful, guys? Using fact and not just my opinion or my emotions personally? That you could just look at that at any time. If you were worried about some sort of event risk, you could say, well, what are the professionals doing? What are all the portfolio managers doing on Wall Street? Oh, I'll just look at the VIX. Huh. Right. Yeah, it's not an early warning system, but you could see, I mean, you could take this even farther. Very often when you see VIX is too low, oh, come on. Often when it's too low, when it's around 10 or 12, then the market can very often be overly complacent. They're not fearful, but you're supposed to have a balance of greed and fear, right? What if it's just all greed? Nobody is insuring their policy because 100% of the market, or in this case, 90% of the market, if you want to interpret it that way, is just long and they're not fearful at all. It's going up and nothing's stopping us and up and up and up. Too good to be true. Okay? So the VIX is simply an index. It's called the fear index. And it shows people buying options on the S&P 500 because they're worried about it falling. And they need to hedge. So that's what that is. And you can find it whatever you want. Okay? But if nobody's buying insurance, that's usually the early warning system. Okay, John? So imagine everybody's long and they know it's bad. And all of a sudden something triggers a decline. Imagine an avalanche. Just imagine lots and lots and lots of stop orders very, very close to market price, and nobody is short. Everyone's long, but everyone's jammed their stop, and all of a sudden, boom! A snowball very quickly turns into an avalanche, and the stock market comes down hard and fast. And so, like I showed, I guess I got rid of the chart, but right before the massive increase in VIX, almost nobody was buying options. Volatility was low, 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 low. Right? And then what happened? The stock market crashed. And then people were buying VIX options on the S&P 500 to hedge as fast as they could. Okay? So that would be your early warning system. You would look at the VIX and say, 12? 11? Oy vey, I think we're at a market top in the S&P 500. There's going to be some sort of decline. You just don't know if it's going to be 2% or 10%. Okay? Yes, Charles. Yes, as I was trying to explain, you can buy an option that makes money if the market goes up. you can buy an option that makes money if the market goes down. You hold it. You paid for it. It's a derivative. So you would buy an option that makes money if the stock market falls. If the stock market continues to go up, you just lose the money that you paid for the option. It's just like now it's a worthless option. You just literally throw it in the garbage. But if the stock market goes down, you make money. And that's why it's a hedge. Because you're losing money in the cash, but you're making money on the derivative. Okay? Yeah. When you're not used to options, what people think when you sell an option, that means you're going to make money on the when it goes down. No. You're actually just out there like a dealer almost. Like, I have an option for sale. I'm selling an option. Would you like to buy an option for me? Right? Get your options here. And the customer comes in. Well, what kind of options do you have? Oh, I got options. I got all kinds of options. I got options if the market goes down. I got options if the market goes up. You can buy a combination of options and you make money either way as long as it goes somewhere. Right? There's all kinds of stuff. But what we're talking about is just the buyer side, and what they're buying is they'll make money if the stock market falls. That's why it's an insurance policy, and that's why a spike in VIX is bad, because you can they're only buying it out of fear. And so what we started to talk about at the beginning was greed and fear. Well, at least now you have a measurement of how much fear. Okay. But I don't want to get into the complexity of options, because you can make it so complicated it's stupid. All right. How about this? Let me move this out. All right. What is the probability of the Fed raising interest rates tomorrow? And I'll answer this. Boom. Okay. The Chicago Mercantile Exchange offers a tool that looks at Fed funds futures. And this is the pit now. Just imagine a pit of traders buying and selling futures contracts. Okay? And prices go up, prices go down, and they're making decisions based on their own analysis. So based on this market now activity, and the market setting the price, because they're buying and selling, the market itself, it has an expectation because they're pricing it in. Some traders are pricing in the rate raise. Some are pricing in no raise. Obviously, they're not going to price in a cut. So, so the market gets together and buyers and sellers set the price. So what does the market think? Okay. The market thinks, based on the way they're pricing, and I'll explain this a little bit, but based on the actual market, this isn't some sort of survey, right? This isn't a guess per se. This is literally what the buyers and sellers of the Fed funds futures market imply through their own auctions, if you will, of buying and selling to each other and setting a market price. For example, if there was a 100% chance they were going to raise tomorrow, do you think that would be priced in right now in the Fed funds market if everyone agreed? Of course. You would absolutely price that in. Why would you buy something unless it was priced in? It's like selling a car. You look at it like, you know what? It's a nice looking car, but the engine sounds terrible. Sounds terrible. I can't buy it like that because I know it's going to need work. And I think the transmission is going to need to be rebuilt. Would you buy it at full price? You buy it, it's no meaning right now. We're not interested. Tomorrow's way bigger. Okay? So you would say, well, look, I'll buy this car, but you need to lower your price because I don't like the way the engine sounds. I'm going to have it looked at and tuned up. I don't know if it's serious or not, but I do believe that transmission needs to be replaced. You got a good-looking car, but if I buy this, I need that priced in. So, $800 for a tranny, let's say another $400 for someone to at least tune up that engine and scope it out and maybe do some things. Maybe it's just a carburetor thing. So, look, you're going to need to come down $1,200. That's how the market works, right? Then what does he say? Well, $1,200 is, a little too much. I don't know. I got a guy interested. He said he wants to buy it tomorrow. And then, you agree on $1,000 less and boom, deal done, right? Well, every market works that way. So they're pricing all of this stuff in. So you can use the price, this 99.8325. That tells you something. Okay? What was the number on the CPI? Dollar weakness on it initially. But whatever, like I said, I don't care. All right. So the futures price is less. It's 99.83. So let's say it's $100. Well, let's not get into that. I'll explain it in a second. But long story short, very little chance of a 50 basis points, right? A 0.5% increase. And very, very high probability of a 0.25, but this also includes no change at all. This is 0 to 25. So that the answer is not 74. The probability of a hike tomorrow, according to yesterday, this was updated yesterday at the close. The close of trading yesterday, the implied probability of a rate hike tomorrow is 25%. That's what the professionals think. This was very, very close to 100%, at one point, and then 80%, then 70, then 60, then 50, then 40, then 30. And the whole time I'm laughing, right? You guys remember that? Every single FOMC meeting of the year, starting in February, I was laughing at how absurd and it was to even think they were thinking about it, yet going to raise interest rates. Like, I was mocking the stupidity of the conversation even. Right? Does anyone here say that's true? Like, I would say things like, absolutely no way, not in a million years, 100% chance that they're not even talking about raising the interest rates. Okay? Charlie, we talked about that yesterday. Cool. Glad you're here then. Right on. Glad you're here then. This is what we're trying to fill these gaps. Okay. So anyways, tomorrow was 25%. And imagine the chart now, it used to be higher and it's falling and falling and falling and falling. Okay? What about October, December, January, March, April, June, and July? What? Isn't this interesting? You can see, what about December? Boom! 59% chance in December. According to what? Surveys? No. Based on the price of the futures contract. Okay? The market itself, through buying and selling with each other and setting a market equilibrium price, the professionals, by way of their actions, because they're making intelligent, logical decisions, are producing this probability of rate hike through the set price. Okay? The market believes that interest rates are going up and they're pricing it in. And in fact, look at some of these things, guys. When you go to like January, let's say, some market participants are pricing in a 1.25% interest rate. You understand? They're actually pricing in an interest rate of 1.25%. Not many, but somebody is. A full 1%, 7.5, right? So you can start to gauge this a little bit. The December guys are already talking about 0.5% to 0.75%. Okay, and that's got to be priced in. So just quickly, I'll give you a link here. This is Fox Business. This picture here you see in the webinar, that's me doing Bloomberg, but I wore a gold tie, I think, when I was on Fox Business. But anyways, here's the link to the article. It's pretty interesting, and it covers how all of this is calculated. All right, I guess I should show the logo. There it is, Fox Business. There you go, Fox Business. All right. Futures and options contract based on the Fed funds rate are traded at the CME Group. That's the website we're just at. Contracts are priced on the basis of 100 minus the average effective federal funds rate for the stated delivery month. For example, a published price of 99.88.5, which is not far off of what we just looked at, right? For the March 2015 contract, would infer the market expected a rate of 0.1150 basis points for that month. Right? So you take the 100, which is the full value, minus the actual price, you get the 115 effective funds interest rate. To calculate the possibilities of a quarter-point rate hike in June, right? So that's March 2015. Right? So that would have been when this was written. Where's the date on this thing? March. Okay. So he's talking about going back in here. He's saying, all right, if you look at the current futures contract, right, in March, it was trading at 99.88. The difference from the full price, 11.5. No, right? Because if interest rates go up in the future and you were holding a bond, for example, you would have to sell your bond for less because the bonds in the future are going to be paying higher interest rates a higher yield. Oh, John likes the tie. Thanks. Yeah, that's a emerald green 7-fold silk tie. So anyway, so if interest rates go up in the future, your contract is going to be worth less. Do you understand? If prices go down, interest rates go up. So if interest rates go up, your old bond is going to go down. We talk about this a lot in the Forex trading world, at least I do with you guys, but you may not understand why, and I'm hoping you really start to understand, like, your bond is now actually worth less. If you had to sell it, someone's going to say, buy it from you. What do you mean? I can just go to the Treasury right now and get something with a higher yield. You're like, well, dude, I got to go to cash. I got to get out of this stupid thing. All right, well, I'll buy it from you, but you're going to have to take a loss. And you're like, all right, well, I need the money, so, right? Does it make sense versus just, oh, there's an inverted relationship between bond prices and yield, and you're like, what the heck does that mean? I hope it just makes a sense. You know how to buy a used car. Do you know how to buy a used bond? That's what a second market is, guys. Someone already bought the bond from the Treasury. Now he's got to sell it. He's like, I don't want to hold it to maturity. I got to get rid of this bond. Well, if it pays higher interest rates than what's current, it's going to be worth more. If it pays less of a yield than current interest rates, then you're going to have to dump it for a loss. But at least you can go to cash, get your money back, and buy something else. Cool, huh? All right. So anyways, this analysis, it's looking at that time, it was March. This was written in March. So that current contract is selling at 99.85. Somebody thinks interest rates might go up. So therefore, you can't sell it for 100. The face value might be 100, but no one's going to pay you 100 if they think, well, I'll just wait, because I think in June they're going to raise interest rates. I'll just wait and get the June one. And this guy's saying, well, or not the author, but the market is saying, well, why don't you just buy my bond from me now? I'll just discount it by 0.115%. And you're like, okay. That's what the market's actually doing, right? So again, this isn't a survey of how people feel. This is actually the buyers and sellers, and they're pricing it in. This is where, oh, it's all priced in. It is priced in. They're actually pricing it in. Cool. So now to calculate the probabilities now from using this information. So if it's going to go up a quarter point in June, so this is March, we're talking about the next Fed meeting now, you would take the current June futures contract price, 99.835. You see this? Now you got the June price and the March price. So take the June price, subtract it from 100, and you get an effective rate of 0.165. So you got 1.65 and you got 1.115, okay? 0.115 March, 0.165 June. Next, you would subtract the 0.165 from the current rate of 0.115, leaving you with the difference between the June and the MAR, as they say, the June contract and the March contract. The difference is 0.5%. To find the probability of a quarter percent increase in the interest rates, you would then take your difference of 0.5 basis points and divide by 0.25, which would be equal to 20% chance of a 25 basis point rate hike in June. Oh my gosh, that makes sense. Or maybe it makes sense, but that's actually what they do. Isn't that cool? What's the price of the March contract? Or actually, we should reverse it. What's the price of the June contract? What's the price of the March contract both trading in March. What's the difference between the two? And take that and put it towards the 25 basis points. Spits it out. There's the answer. So once you know, now that you're smart money, guys, now that you're smart money, you can go through all of this and completely understand. I should be able to say, all right, this is September contract. What's the price for the October contract? Because it's all there. Well, how'd they get the probability? What's this price? Right? And then you should be able to figure out what the next one is. But I don't think we need to go into it academically, right? Because you're like, psh, blow your mind. But you should be able to figure out. Cool, huh? So anyways, 25% chance of the Fed raising interest rates tomorrow. What do you think, guys? Interesting stuff? John says, good thing 0 and 2.5 is not separated. It actually is. I think what you're talking about is this one here is 0 to, that comes out to 74%. But then you use different methodology to come up with the probability. And that's 25%. But, okay, 25% of them actually raising. Again, based on price, guys. Price differentials between two different contracts. Okay, but that's set by the experts, right? Who's the experts? The actual market participants. So, what's the interest rate going to be in December? Well, the majority have already priced it in. Okay, it's either a quarter or 50, and they're figuring that out as they go. According to the market, interest rates will be either 25, will be up 25 basis points or 50. And they're figuring it out as they go. And I think obviously, okay, so let's talk about this, cause and effect. What happens to this tomorrow, or is tomorrow Thursday? I don't even know what date it is yet. I always have to check. Yeah, tomorrow's the 17th, so that's a Thursday. All right. So tomorrow, if they don't raise interest rates, what change will you likely see on this page? Well, these will immediately adjust. And the chances of them raising it 0.5% in December would drop exponentially. Don't you think? Okay. How about this? These people here that are pricing in 0.75 of a percentage point, what they're telling you is they think they're going to the Fed will raise interest rates in September, October, and December. Quarter points each, most likely, right? I mean, you could debate that they do what? 50 now and what? Then skip October and then, I mean, whatever. But a lot of people are thinking they're going to raise, pause, raise, pause, raise, pause. Right? That's what Australia does, for example. So I think a lot of the market would shift out of the 50 basis points. If they don't do in September, then they're going to say they're not going to do it in October. So therefore, the only rate this increase this year would be December. and the probability of interest rates being at 0.50 at the end of the year would drop exponentially. But wouldn't the expectation of a quarter point still be very high? Yes, I mean, Yellen said she would, so this would probably go up. This would almost definitely drop a lot. And this would probably go away, and we wouldn't even discuss this. Okay? So we're going to learn a lot tomorrow. And the market's not that sure, right? It could go either way, basically. Okay? So anyways, knock yourself out with that. I hope you enjoy being smart money. Yeah, Lewis, they're actually discounting current futures and increasing the value of future contracts because they already believe the interest rate is going to be higher in the future, and they're already adjusting current prices based on the assumption that things will change by rates going up. It's not a discussion, it's not a bet. They're actually buying and selling these products to each other, and the market is already adjusting its price based on the expectation of future changes, whatever the change may be. In this case, interest rates going up. Okay, as far as they're concerned, the interest rate has already gone up. And if they don't raise interest rates tomorrow, those prices will need to adjust based on new information. Okay? That's what they mean pricing it in. They're like, once again, if you expected, you're looking at a used car and you just expect, you don't know, but you just expect the transmission is bad. But you're willing to buy the car anyways, you're just going to have to negotiate a lower price to offset your risk. That's it. So you negotiate. That's how the market works, guys. That's how the foreign exchange market works. It's a big negotiation in real time with lots and lots and lots of players. Okay. Yeah, Felipe, it'll be in the back office or your private office at tradersway.com. If it's not there now, don't worry about it. It'll be there tomorrow, and I'll send out an email and stuff like that. So again, tomorrow at 1:30, I'll do a special event. I'll teach you everything you need to know about the Fed, the FOMC, the Board of Governors, and the FOMC meeting, specifically what they discuss, in what order they discuss it, and who says what at an FOMC meeting. Then we'll get the information, right? The announcement will be released. We'll trade the volatility, and then at 2:30, Grandma Yellen speaks, and I'll cover that for an hour. We'll listen to the testimony and the Q&A with Grandma Yellen, and then a big group hug, and we'll be done for the day. Okay? So, hey, honestly, from the bottom of my heart, I appreciate what you do. I know you're trying really hard. I know you're improving as a trader. And I thank you for, your loyalty to coming to these events. If you're watching a video of this, a recording of it on YouTube, please leave a like. But yeah, I appreciate your loyalty. It's so at some point when you're ready and you feel confident, put money into a live account at tradersway.com, and that keeps these sessions going, and we can work together for days, weeks, months, and years to come. And I look forward to your unbridled success. So peace on earth, may the pips be with you, may your profits be above average. Cheers. Gee whiz, my mouse is so terrible. There we go.